Hello and welcome to Wealthion. I'm your host, Andrew Brill. The stock market indexes continue to move to record levels. The economy seems to be in good shape, but is it really? We'll get to the bottom of what might really be going on coming up next. Our mission here at Wealthion is to help all of us keep and grow our money, but Wealthion's not just a channel, it's a conversation with our community. So please, keep the feedback coming. If there's something you'd like us to talk about or someone you'd like to hear from, let us know. And if you could like and subscribe to the channel, we really appreciate it. Now let's dive into our discussion. I'd like to welcome a veteran of Wealthion, Peter Boockvar. He is the Chief Investment Officer at Bleakley Financial Group. He's the editor of the book report and a contributor to CNBC. Peter, welcome back.
Good to be here. Thank you.
Let's dive right into it. I've heard some of your commentary. You're not as bullish on the economy as many others are.
The economy is very much a mixed bag, and you can really slice it up, and it points to that. You have the high-end consumer, which is spending robustly on travel, leisure, hospitality, going out for dinner, going to concerts, going to sporting events, but not spending as much on goods. You have the lower middle-income consumer that's prioritizing their spend, being very quote-unquote choiceful, as the CFO of Walmart said, on their spend. You have the pace of housing transactions of existing homes, the slowest in about 30 years, but you have better new home builds as more supply is needed. You have manufacturing that's in a global recession. On the other hand, you have all this government spending and tax incentives that's helping to lift the manufacturing of manufacturing facilities, in addition to infrastructure spend. Global trade is relatively muted. You have capital spending on AI, but you have less capital spending on other things, where on a net basis, capital spending was pretty flattish in Q3, Q4. So people like to talk in platitudes and homogeneous things. The economy is great, the economy is bad, it's in an expansion and a recession. But I think it's more important to dig under the hood and see where the strength is and where the weakness is.
So, I get all that, and the consumer spending really troubles me because, you see everybody spending all this money, and like you said, it's on, luxury items or things that are just going to make them happy. It's not really on the durable goods side. What economic indicators do you look at to look at everything other than what you just said? What are the things that you're looking at to get to where you've just mentioned and realize the economy is not as rosy as everyone says it is?
Well, in addition to looking at all the different data points, I listen to an extraordinary amount of earnings conference calls, whether it's stocks that we own or stocks that we don't own, that always tell a good macro story, either up or down. So if you listen to a lot of company calls, I would say the economy is pretty mediocre. And a lot of economists and macro people out there that talk about how great the economy is are not listening to these calls, that they're pointing to a much more mixed situation.
When you listen to these calls, obviously it's the financials. They've kind of happened in the past. We look at forward guidance. Is the forward guidance something that you're looking at and listening to and saying, well, given the numbers, I'm not sure how they're going to reach where they are, or given the numbers, that seems far-fetched? How are you interpreting what they're talking about going forward?
Well, I still think that there's very limited visibility for companies. They don't know what the Fed is going to do. They talk a lot about a challenging macro environment. If you're a big multinational, you're seeing a recession in Germany, and for the Euro region in total, basically no growth. You see weakness in China. On the other hand, you see strength in India and other parts of Asia. So it's very much a mixed bag, and I don't think company CEOs are really putting themselves out there in terms of confidence in their guidance. I mean, definitely with guidance, there's a level of vision out there based on order rates and so on. But I think people still acknowledge that there's a lot of cloudiness out there, that they're just trying to get through quarter to quarter.
What kind of cloudiness are you referring to?
Well, on the interest rate side, if you're in commercial real estate and you have a loan coming due, I would say there's a lot of cloudiness this year. If you're selling to the U.S. consumer, right now things seem to be good depending on what type of consumer you're selling to, but other consumers are not. So I think it's just a very difficult macro environment, and in terms of trying to forecast it. I don't think I've seen this many mixed signals in all the years I've been doing this.
When you talk about interest rates and manufacturing, are the interest rates keeping the manufacturing at a low level, or because it's obviously harder, not harder to borrow money, but more expensive to borrow money at this point to grow inventories?
Well, manufacturing is in a recession mostly because consumers have shifted their spend to services from goods over the past year plus. And also a year ago, a lot of retailers got overloaded with excessive inventories, and they've been very disciplined in trying to right size their inventory levels. And I think that that can be said for a lot of different parts of the economy, that the inventory situation is getting more in line, but there hasn't really been any impetus yet to restock because consumer spending is still somewhat muted on the good side.
The consumer spending numbers are still relatively pretty good. You expect those to continue.
Not really on an after inflation adjusted basis. They're rather mediocre.
So you can expect that to continue to come down a little bit.
We'll have to see the trajectory of inflation. That's even, a mixed bag. Inflation's moderating. Services side is going to continue to moderate. But all of a sudden, you have gasoline prices at the highest level since November because oil is at $80. And we have the possibility that goods prices are bottoming out. So there are a lot of moving parts here to such an extent that it's very difficult to really call. And I think the Fed is going to have their own internal confusion on what to do. And certainly with the giddiness that the markets had at the end of last year, thinking that the Fed was going to cut 6 times this year, that has been dramatically reined in. But even 2 to 3, the Fed is still uncertain on when to pull that trigger.
So you think that there's a lot of credence being paid to what Jerome Powell might say this week, because that's going to, again, look at forward guidance on when there might be a rate cut.
Yeah, I mean, it's with the stock market doing what it's doing, you wonder what's being restricted in the economy and why should they even cut interest rates. On the other hand, if you're in real estate, you're desperate for interest rate cuts. So it's a very difficult juggling act here on the part of the Fed.
Even with the interest rates where they are, obviously housing starts are down a little bit. First-time home purchases were down a little bit. But the interest rates in terms of a mortgage aren't really that bad. We've seen much worse in the past, but they're not that bad. It's obviously more expensive to borrow money right now than it has been over the last several years. But the interest rates aren't impossible, I guess I'd want to say.
Well, on an absolute level, yes. But the problem with interest rates where they are is it comes after 15 years of zero. So yeah, mortgage rates, historically speaking, at around 7, it isn't that bad. But when it's more than double it was just a couple of years ago, well, that's a shock to those that are trying to buy a house. If you were in commercial real estate and you borrowed at 3, but your loan's coming due and it's repricing at 8 or 9, well, that's a tough thing. Historically, yeah, maybe 8 you would make work, but not after it was up from 3.
More people are looking into renting rather than buying. Do you expect that trend to continue? Even though rents have come down slightly, do you expect people to rent until until interest rates come down and they're able to buy something at a rate they're happy with?
Yeah, rental growth has been pretty strong for years. And if you include the rollover of existing leases, rents are still rising, even though they're rising at a much slower pace because the decline or flatlining of new leases, but renewal rent leases are still rising at about 3 to 4%. And yes, with home prices at record highs on top of more than doubling in mortgage rates, there is going to be a pretty persistent demand for rentals. Now, luckily, from the renter perspective, there's a lot of supply coming online this year, about 1 million units. But after that is absorbed, which it will be, 2025, 2026, you'll start to see a rise in rents again because there's really very little new shovels being put in the ground to build a new multifamily apartment because of the high cost of capital and because of the moderating rents that we're seeing.
So the cost of capital is really keeping the building at a minimum at this point.
Well, for new construction, yes, but there's a lot of construction that started a couple of years ago before this rate spike. Once that gets absorbed, you'll see a big drop off in new supply.
I guess that's because of the goods are being more expensive, and to borrow money to put these things together are also probably more expensive as well, because to borrow that money is going to cost the builder more money.
Exactly. I mean, deals just don't pencil out when your borrowing rate is 8 to 12% when versus 3 to 4.
You had talked about people spending more things on leisure goods. Why do you think that is at this point rather than on durable goods? I know that, during the pandemic, everybody did work on their house because they were home a lot. And I guess that work was done, but there's still other things that people could buy rather than spend money on, going on a trip or a really nice meal or, leisure goods, things that are just going to make them happy. That's that trade-off between the durable good and something that's going to make them just feel good.
Well, you're not going to redo your kitchen every 3 years or put in a swimming pool again, since you already have one. So there was a lot of pull forward that took place with spending at least on things around the house, and now you have, I said, a 30-year low in the pace of existing home transactions. Well, if someone's not leaving one home to move into another, and someone is not moving into the seller's home, well, you don't need to buy carpet, you don't need to buy paint, you don't need to buy new flooring, you don't need to buy new furniture. So there's also activity there that doesn't get done. Uh, you look at the auto sector, yeah, auto sales are hanging in, but there are affordability issues there as well, and dealers are now having to rely on incentives to move product. And even on the home side, for new builders, they've had to deal with incentives in order to entice someone to buy a home, whether that's buying down a mortgage rate or a teaser rate or discounting the house or giving extra stuff. There's been a need to incentivize to buy this stuff. So if someone's going to use their discretionary money and they're not buying other stuff, maybe they're buying a handbag, for example, or jewelry, but they're not buying the big ticket stuff to the same extent, which then frees up money to go see a Taylor Swift concert, for example.
Which wouldn't be cheap, by the way.
Certainly not.
Salaries seem to be on the rise. Is it possible that people have a little bit more expendable cash in their pocket because salaries on the rise and they're not spending that money on durable goods, but maybe they're saving a little bit more and spending a little bit more on things that are going to make them happy? Does salaries come into play there because they're a little bit on the rise?
Yeah, wages and salary growth has been pretty good. It's definitely plateaued, maybe moderating a bit. But if you look out over the last couple of years, it's been running at least at about double the pace of wage gains pre-COVID. So that's definitely been sort of a mitigating factor to the sharp rise in inflation we've seen over the last couple of years. And now now wage growth is actually above the rate of inflation. So we're seeing some real wage gains, but that of course comes after a very notable cumulative rise in inflation relative to wage gains. So it's sort of just a catch up. But that's why the consumer still is hanging in there. But again, there's still consumers that are searching for value. I mean, it tells you something when Walmart says for multiple quarters in a row that more people making over 100 grand are shopping at their stores. People are not doing that because Walmart's got this great apparel section. It's maybe because people are looking for more value.
Yeah, I think and look, I think even if you had the money, you should be looking for value. That just makes sense. Let's talk about the expenditures versus the price index, the consumer price index. Obviously, what the expenditures reported by businesses, the consumer price index reported by consumers. There seems to be a discrepancy there, not a discrepancy, but a gap there that's higher than usual. Usually it's around 0.4%. Right now it's hovering around 1%. Is that troublesome at all? Is that a signal of some sort?
It's a measure on how those two numbers are calculated. I don't like PCE because the biggest component is healthcare, and the biggest component of healthcare is Medicare and Medicaid reimbursement rates that the government price fixes. So I don't know why the Fed has that as their leading inflation gauge when the biggest chunk of the number is being manipulated and price fixed by the government. CPI has a lower healthcare weighting, and healthcare that's measured by out-of-pocket expenses, which seems to be more real life, and has a bigger component in housing, which in reality actually measures, the average renter's income that is dedicated to rent is better captured percentage-wise in CPI than PCE. So I think PCE is a flawed number, and But the discrepancy between the two has to do with what I just mentioned, with the two biggest components.
Are we looking at inflation the wrong way? Like you just said that, you don't like the expenditures number. Is there someplace else we can look? I mean, in the day of analytics and sports, everybody's looking for that competitive advantage and ways to get it. Is there a way to look at inflation and say, okay, this is the real number? There seems to be all kinds of opinions, but is there a way to look at it where we can really get a true picture?
Well, there's something called trueflation, which measures uh, a lot of different goods and service prices every single day. So that's actually a pretty good uh, up to the minute indicator. The only problem with that one is that it doesn't seasonally adjust. So if there's discounting around the holidays, rental prices usually decrease November, December, January, starts to increase in February, March, but Trueflation doesn't seasonally adjust for that. So that's the one flaw with that number, even though it is a pretty timely measure of a variety of different prices.
And what goes into trueflation that we wouldn't ordinarily think about?
No, it's just measuring thousands and thousands of prices and all different things. But it's something that spits out a number, I believe, every day, as opposed to having to wait every month for CPI and PCE.
So like the more data you have, the more precise you can be, obviously.
Right, but again, I gave a caveat that it doesn't seasonally adjust. So we just have to acknowledge that when we're, you know, don't look at December rental prices in Trueflation, watching them slow and think, oh wow, that's going to be the case for the rest of the following year. It just seasonally happens to slow in December as people are focused on the holidays and not looking to move.
Peter, one of the things that the Fed seems to look at is unemployment numbers. And they seem to be very good, or I should say the reported numbers seem to be very good at this point. But, we're getting talk of layoffs left and right. I think January was the biggest, reported layoff month since 2009. When will this affect the economy? Because there's a lot of people out there now without work, but for some reason, or going to be without work, but for some reason, it's not being reported in the numbers.
Well, the labor market is another confusing aspect of this economic analysis. You have the pace of firings as measured by jobless claims relatively muted, as certainly a lot of companies that had difficulty getting workers back after COVID aren't looking to get rid of them so quickly. They want to hold on to them. But then you have continuing claims, which are at multi-year highs, measuring a slowdown in the pace of hiring. You've had the establishment survey within the BLS number being very strong, but the household survey being somewhat soft. You have job openings that are slowing. You also have ADP, which has shown much more softer jobs increases relative to the BLS. And you also have like ZipRecruiter, for example, that's an online staffing firm that has seen very modest growth for quarters now, talking about the slowdown in the pace of hiring. So a lot of mixed signals, but I think net, the pace of hiring is slowed, pace of firing still remains very muted.
Are we looking at, Peter, the jobs that are becoming available, the hiring that everybody's talking about? Are we looking at lower paying jobs and the people who are getting laid off or fired not being able to find something in the economic range that they were there before? In other words, they're going to have to take a pay cut to go back to work. So maybe they're waiting a little longer to go back to work.
That's possible, but it's hard for me to measure that and to what extent. I still think that depending on what industry you're in, really mostly if you're in a business where you need people physically on site, whether that is an airline or a hotel or a restaurant where you need people there, there's still labor shortages here and there, and wage growth is still pretty persistent. If you're in tech that overhired over the last couple of years, that's where there's been certainly a level of softness. And depending on construction, for example, or manufacturing, it's been a mixed picture. Manufacturing is in a recession, as I said. Therefore, there's less need for workers. On construction, if you're building a battery plant in Kansas City because of government incentives, well, you have a job. But if you're in new build in commercial, well, I don't really see too many new office buildings going up.
So, are there different aspects of the economy that could be in a recession, and some aspects that are doing? Obviously, AI seems to be, doing okay because, or anything involved in AI seems to be doing okay. But are there parts of the economy that are already in recession?
Well, I mentioned earlier manufacturing around the world's in a recession. The existing home market is in a recession. The lower income consumers in their own personal recession. Global trade is maybe in a recession. And then obviously you have offsets. But yeah, there are parts of the global economy certainly in a recession. If you're in the residential real estate market in China, you're in a rather deep recession.
In your opinion, parts of the economy are in a recession. Everybody's talking about this soft landing. Is this going to be a little bit harder than we expected?
It remains to be seen. I don't even know how to define a soft landing. I think a lot. I think a lot will depend on with the interest rate situation. I think a lot has to do with the stock market. If the stock market hangs in, then maybe we can avoid a harder landing in the economy or even a recession. If the stock market rolls over for whatever reason, well, then that strength in the higher income consumer could be threatened. Uh, and you can be sure that the higher income consumer is not going to be spending as much if the S&P is at 3,000 relative to 5,000. So that is also a key sort of factor in where the economy goes over the next year or two.
Yeah, one of our Fed chairmen once called it irrational exuberance in terms of the stock market. Are we there? Because it seems like no matter how, and the numbers haven't been bad, but how, you look at the numbers and say, okay, they're starting to come down a little bit, but the stock market just keeps rocketing. Are we, irrationally exuberant at this point in terms of the stock market?
Well, when you're trading at 24 times trailing 12-month earnings estimates with the fastest 40 years rise in interest rates, yeah, there is a level of giddiness and sort of nonchalance about the rise in rates and the belief that somehow if we run into trouble, the Fed's just going to cut rates and everything's going to be fine. I think when Nvidia adds $230 billion in market cap because they raised revenue guidance by 2 billion, that's a level of irrational exuberance. But that doesn't tell you anything about where the markets go in the short term at all. Just tells you that we're stealing from some future returns, but this kind of behavior can last. But it doesn't seem like it's on firm footing when it just sort of gets carried away on pure momentum and chasing rather than anything else. Now, Nvidia's numbers were phenomenal. I'm not going to pick on Nvidia, but I just think it's important just to have some perspective on the market cap move relative to the numbers that they reported.
So I'm going to ask you to put on your psychologist hat for a moment because you're the investment advisor. But is it okay to miss out on this run? I mean, knowing that the stock market traditionally continues to rise a little bit, but should we forego the quick cash in our pocket and just say, look, you know what, sit back, enjoy the smaller gains that are going to go over a longer period of time, or should we try and hop on this? There's that fear of missing out, and we need to kind of get away from that, I guess. Because if you jump on the short ride, there could be a very short fall as well, I would assume.
Well, personally, I have no fear of missing out. If something gets away from me, I don't really care. Maybe there's some frustration missing out when you see certain things going through the roof, but uh, that's it. Now, if someone wants to just sort of trade and like the casino mentality of the stock market, yeah, I guess they can hop on board. But we look at the markets as investors, and that's not how we play the game. We look for long-term opportunities and have a long-term time horizon. And luckily, our clients are in some of these names already that we don't have the pressure of chasing. But chasing is never really a good strategy over a long period of time. It may work in the short term, but it's never really a good long-term strategy.
I want to talk a little about a long-term strategy, which is gold and precious metals. And is that something that you would suggest getting into, or something that some of your clients are in?
So I've been a bull on precious metals for years. So we're already in, and I've been telling people to get in for years now. It does seem that finally uh, gold is about to have its day, with it closing this past Friday and will again today at a closing record high. And this is something that goes back 5,000 years. I do expect further upside. I do expect silver to catch up, and I do expect the miners, which have so badly lagged, to also catch up as well. So we're pretty bullish, have been, and remain so.
Peter, tell me how gold works. A lot of people say, you buy gold and it's like a piece of art, kind of hanging on the wall, leave it there, forget about it. It's an investment. Is that, I mean, gold is obviously a commodity, something you buy and you hold on to. It seems like people are talking about it more like a security at this point. How does it work with gold? Is it something you should buy and hold on to for a long period of time? And if that's the case, when do you sell it?
Well, gold is money, and it has been, as I said, for 5,000 years. Now, you're not going to go to your local restaurant and pay your dinner with a gold coin in terms of a medium of exchange, even though, of course, you can run to the gold dealer, exchange it for dollars, and then go to the restaurant, of course. But central banks are not buying gold hand over fist because it's like art on the wall. They saw that the U.S. and the EU confiscated half of Russia's foreign central bank reserves, and a lot of central banks which hold monetary reserves said, you know what, maybe I should own more gold in my hand rather than buying U.S. treasuries. Gold has traded extraordinarily well the last couple of years in the face of a strong dollar relative to some currencies and a very sharp rise in interest rates. And that told you all you needed to know about the strong bid under gold from these central banks. While the Western world, via ETFs, have been selling gold hand over fist for a while now. But at some point, I think that's going to change, reverse back, and investors are going to realize that in today's somewhat chaotic world, particularly with not just on the geopolitical side, but particularly the financial side, with U.S. debts and deficits, that gold has really maintained its level of purchasing power over the years, unlike the dollar, which over the past 100 years has basically lost 98% of its purchasing power.
A lot of people some now are comparing Bitcoin to gold. I don't think they compare, but Bitcoin in the last couple of weeks has shot up as well. What's your view with Bitcoin? Is all that all something that people should get into as well?
Well, I have no opinion on the price of Bitcoin. It's obviously getting a help from all these ETFs where money's piling into, and therefore the ETFs are buying Bitcoin. So that's just a short-term supply-demand imbalance. So I really have no idea where the price is going to go. Bitcoin has been, up until this last run, people thought it would sort of replace gold, but something that's less than 20 years old doesn't replace something that's 5,000 years old. They can complement each other. I still think that remains to be seen what Bitcoin will be when it grows up. Not sure, but it's a great speculative instrument right now. It's perceived to be a store of value right now because of its limited quantity, but Mickey Mantles in 1968 are of limited quantity too, and they're not making any more of that. And I don't see that having the same price performance as Bitcoin, and I'd rather own a 1968 Mickey Mantle than Bitcoin.
What's the best investment advice you've ever gotten or given, I guess?
I don't think of along those terms of the best. I think that there are a few different things of just when you're going to invest and approach the markets, buy what you understand. Don't buy somebody else's stock pick. There's no one way of making money in markets. Everyone has their own style that suits their own personality. And I think risk management is probably one of the most important parts of the investment world, and being able to look in the mirror and acknowledging when you're wrong.
In the volatile situation we're in with the market up and down, how do you minimize the risk?
Just constantly researching my thesis and trying to come to terms with when I feel like I'm wrong and when I'm not. I don't think there's necessarily one way of managing that risk. It's also keeping positions within a manageable percentage of the total portfolio. But I think just constantly reassessing your thesis is a great risk management tool.
Peter, thanks so much. I really appreciate it. I know we can find you on Substack. You're the editor of the book report, and we can find you on CNBC from time to time. But where else can people find you, like on social media?
Well, I'm on Twitter at Boockvar, Boockvar, and also if they're interested in wealth management services, they can check out our website at bleakley.com.
Anything that about this market right now that really, really bothers you, that you sit back and you say, this is really bothering me. It's not reality at this point.
I've heard for decades, don't fight the Fed, and it seems like the stock market's waking up every day, desiring to fight the Fed.
Do you have an opinion, or do you have a feeling of what Jerome Powell might say this week?
I think he is going to sound as confused as I am on the economy. Therefore, not giving in to the market's desire for many rate cuts. I think the market has finally begun to price that in. I think Jay Powell is very afraid of watching inflation flare up again, and he doesn't want to see that happen on his watch. And I think the other thing that's going to be very important to hear from Jay Powell is what his plans are for the balance sheet.
Well, Peter, thank you so much for joining me. I really appreciate it. And your insights are obviously always valuable. And it's always a good talk. And we would love to have you back on again if you'd have us.
Great. Absolutely. I appreciate being on.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head on over to wealthion.com, sign up for a free, no obligation consultation from one of our vetted registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. Thank you for watching. And until next time, stay informed, stay empowered, and may your investments flourish.